Borrowing was suddenly the easiest thing in the world, and overnight, everyone's favorite national pastime wasn't baseball anymore. It was buying a house. People were getting approved for massive mortgages while earning barely enough to cover basics. Adjustable rates, balloon payments, ninja loans, no income, no job, no assets, no problem. Home ownership wasn't just shelter. It was the American dream, sold through every billboard and seminar. Banks agreed so enthusiastically, they started throwing money at people like it was a game show. Thus began the subprime frenzy, loans for people with bad credit, unstable income, or a vague idea of what money even is. Bad credit? No credit? Living in a van? Congratulations, you qualify for a luxury condo. And if you couldn't pay it back, lenders shrugged. Prices skyrocketed. Neighborhoods doubled in value in months. Down payments became optional. If you had a pulse, you had a mortgage. Houses were being bought like instant noodles. Loans printed like monopoly money. Brokers made commissions faster than they could say bubble. And all of it rested on blind faith that housing prices always go up, until they didn't. By the mid-2000s, buying a house wasn't about stability anymore. It was about flipping properties like pancakes and hoping the next buyer paid double. Real estate became a lottery ticket. Teachers bought condos after work. Baristas were offered penthouses during their shifts. This wasn't investing. It was obsession. Behind the shine, the rot grew. Subprime mortgages were terrible. High-risk loans with barely verified information. Wall Street bundled the junk together, slapped a fancy label on it, and sold it as safe. Mortgage-backed securities became the hottest product in finance, plastered with AAA ratings from agencies being paid by the banks themselves. These bundles were filled with bankrupt borrowers and unstable incomes, yet magically labeled investment grade. Then came collateralized debt obligations, complex, glittery piles of even riskier loans disguised as financial gold. A few oddball investors read the fine print and saw the rot. Instead of buying in, they asked a dangerous question. What if we bet against the whole system? Wall Street laughed, then happily created a product for them, thinking it was easy money. Enter credit default swaps, insurance that paid out if mortgage bundles failed, even if you didn't own the mortgages. It was like buying life insurance on your neighbor's grandma and hoping she slipped on the stairs. The entire financial system became a Jenga tower of lies and leverage. Whistleblowers were ignored, regulators asleep, and greed ruled every hallway. Then, the tower began to shake. It started as a whisper, a missed payment here, a foreclosure there, empty condos in Vegas. Then it became a wave. Home prices falling. That wasn't supposed to happen. The subprime loans began imploding first, detonating the mortgage-backed securities built on top of them. Banks suddenly realized their safe assets were financial plutonium. Panic erupted. Hedge funds hemorrhaged billions. Investment banks took massive hits. Then, the unthinkable. A major titan collapsed. When a legendary Wall Street institution vanished overnight, it sent a shockwave through the global economy. If they could die, anyone could. Banks froze. Credit evaporated. Businesses couldn't make payroll. Families couldn't get mortgages. Retirement accounts shrank. Jobs vanished. The crisis spread from Wall Street to Main Street, then across oceans. Markets seized. Economies staggered. By late 2008, the global system was in freefall. Millions were unemployed, foreclosures stacked like junk mail, and unemployment offices looked like disaster relief camps. This wasn't just America's crisis. It became a worldwide meltdown. International banks buckled, markets crashed from Europe to Asia, and confidence evaporated everywhere. The world stared at an economy on the brink. Then came the impossible choice for the U.S. government. Let everything burn or bail out the very institutions that caused the disaster. They chose the bailout. Enter the $700 billion rescue package designed to keep the financial system alive. Banks got lifelines. Insurance giants received massive aid. Even car companies were saved. Meanwhile, the Federal Reserve slashed rates to near zero and unleashed quantitative easing, printing money to stabilize markets. Slowly, the bleeding stopped. But while Wall Street recovered, Main Street struggled. Millions of jobs were gone. Homes lost. Life savings erased. Families who had never missed a payment suddenly owed more than their homes were worth. Rage simmered. While ordinary people waited in food lines, Wall Street bonuses quietly returned. The people who caused the collapse got golden parachutes. The people who lived through it got eviction notices. Frustration erupted into protests. Crowds filled parks, holding signs like, "We are the 99%. It wasn't just about the bailouts. It was about a system that protected profits but socialized losses. No major Wall Street CEO went to jail. Trust in the system was shattered. A generation grew up knowing one lesson. When banks mess up, they get rescued. When you mess up, you get wrecked. And the next crisis? It always looks harmless until it isn't.